Ray Dalio is one of the few investors whose career spans every major market cycle, from the crash of 1987 to the dot-com bust, the 2008 financial crisis, and the COVID-19 shock, and he's still sounding alarms. He now cautions that the U.S. economy could face shocking developments, driven by surging debt, trade tensions, and possible monetary disorder that remind him of the late 1990s dot-com bubble. In what follows, we'll journey through Dalio's extraordinary market track record, explain exactly what he means by shocking developments, compare today's market environment to the dot-com era, and discuss why his warnings matter for investors today. Ray Dalio's legendary career and market experience. From Bridgewater's founding to today, Dalio launched Bridgewater Associates in 1975, growing it into the world's largest hedge fund and one of the most consistently successful asset managers. Over 5 decades, he's endured the 1987 Black Monday crash, the 2000 to 2002 dot-com collapse, the 2008 global financial crisis, and the 2020 COVID-19 downturn, experiences that few investors live through more than once. His all-weather portfolio philosophy stems from learning in each of these crises that diversification must balance true risk correlations, not just asset classes. More crashes than bull markets. When Dalio quips he's survived more market crashes than most people have experienced bull markets, he's highlighting that many investors only live
A
through one
timeless
upcycle in their
rule
careers,
is
whereas
that
he's navigated
an
at least
investment
4 major
is a
downturns.
lump sum payment
This
for a
track
future
record
cash
lends
flow.
weight to his current macroeconomic warnings. He speaks as someone who's studied every type of
So
cycle,
now
not
the
just
question
athletes
is,
of the
what is the
latest
future
uptrend.
cash flow going to be like?
What
What are the
Dalio
two
means
most
by
fundamental
shocking
building blocks?
developments, mounting
Inflation and
U.S.
growth.
debt and
They
deficits.
can go up or they
Dalio
can
warns
go
that the
down.
U.S. national debt, now over $36 trillion, and deficits above 7% of GDP, create a supply-demand imbalance that could force debt restructurings or extreme policy measures. He argues such imbalances tend to culminate in shocking developments, like currency devaluations or capital flow disruptions, events far more severe than a standard recession. Trade tensions and tariffs, citing former President Trump's high tariffs, up to 145% on some Chinese imports, Dalio warns these policies risk destabilizing global trade, undermining confidence in the U.S. dollar and accelerating de-dollarization. In his view, chaotic tariff swings echo the policy missteps that exacerbated the Great Depression in the 1930s. Risk of monetary order breakdown. Beyond national policies, Dalio sees a potential breakdown in the global monetary system. If investors lose faith in U.S. Treasury solvency, all other assets could tumble. He's used exactly this language, warning of a monetary order breakdown globally, urging a return to disciplined fiscal and monetary coordination. Comparing today's market environment to the dot-com bubble sky-high tech valuations, like the late 1990s, today's enthusiasm for AI and tech has driven valuation multiples to extremes, especially in the NASDAQ 100, reminiscent of the dot-com bubble peak. Dalio notes that when investors heap speculative bets on what they think will be the next big winner, rather than on concrete fundamentals, they risk a bubble that pops once sentiment turns. Echoes in market structure. Back in 2000, individual tech stocks swung wildly in response to headlines. Today, mega caps like Nvidia move billions in market cap on one AI announcement. Dalio argues that higher interest rates today could be the pin that pricks this bubble, just as rising yields punctured exuberance 25 years ago. Why this matters for investors. Preparing for multiple scenarios. Dalio's holy grail of investing suggests building 15 uncorrelated risk-balanced return streams that collectively perform across different regimes: growth, inflation, deflation, and so on. By learning from past crises, leveraging lessons from 1987 to 2008, investors can design portfolios that don't just chase bull markets, but survive and even thrive in shocks. The value of historical perspective. Dalio reminds us that each big debt cycle and market bubble follows recurring patterns: excessive leverage, policy errors, and then corrective chaos. Recognizing those patterns today, both in U.S. fiscal imbalances and frothy tech valuations, is critical to avoiding the losses many suffered when the dot-com bubble burst. Ray Dalio speaks when the stock market takes a nosedive. You see headlines screaming, crash, or correction, and your heart sinks. A lot of folks in that moment think, I've got to get out now before I lose everything, and they start selling their shares in a panic. Others might say, I'll get out now and jump back in when things look better, trying to time the market, sell high, buy low, or at least that's the goal. But here's the rub. That's almost impossible to do consistently and usually ends up costing you more money than if you just
relative to
left your
what's
investments
discounted in the
alone.
market.
In an
It's just the
Investopedia
surprises
Express interview,
that cause
an
those
online
movements,
chat where
those
they
relative
distill
movements.
complex
And so
investment
by having
ideas
those
into
four
bite-sized
quadrants
insights,
and putting
Dalio
25%
said,
of my risk in
don't
those
panic,
quadrants,
sell.
I achieve
Don't try to
balance.
guess the
The
exact
notion
bottom
of
or top.
balance is going
That
to be
advice
better
might
than
not
not
sound
balance.
earth-shattering until you realize how
Because
counterintuitive it is. Most of us have been primed to react when markets wobble. Oh no, sell everything. Or, hold on, I'll wait for the panic to subside before I buy back in. But Dalio flips that script. Instead, he suggested a few key things investors can do to protect themselves when trouble looms, and they go against the grain of fear-driven decisions. While he didn't say, just huddle in cash under your mattress, he emphasized building a portfolio that isn't overly reliant on any single risk factor. In plain English, diversify across very different assets means imagine you're at a buffet. You wouldn't pile your plate with only one dish because if you hate that dish, you're stuck hungry. Dalio says mix stocks with bonds, maybe some real estate or commodities, and even a dash of uncorrelated assets. When one area tanks, another might hold steady or even rise, cushioning the blow. Balance your risk, not just your dollars. It's not about having 50% stocks and 50% bonds on paper. It's about making sure the risk those investments carry don't all move in the same direction. That way, your total risk exposure is smoother. Have a rainy day buffer. It means keep enough liquidity, cash or cash-like instruments, so you're not forced to sell into a panic if you need money. This is like storing extra water and supplies before a hurricane hits. Rebalance periodically. Markets don't stay static. If stocks run up, they might become a bigger slice of your pie, increasing your risk. By rebalancing, selling a bit of what's done well and buying a bit of what's lagged, you keep your risk profile consistent. Embrace the cycle, don't fight it. Dalio points out that markets go through inevitable boom and bust cycles. Rather than hoping this cycle will break the rules, prepare for it. Understand that downturns are part of the game, not a reason to run for the exits. So, in a more conversational nutshell, Dalio is saying, when the storm clouds gather, don't sprint for the exits shouting, sell. Instead, make sure you've already built your house on strong foundations, diverse, balanced, and with a dry basement for extra shelter. Timing the market means trying to guess the exact moments to buy low and sell high. Almost no one does this successfully, especially consistently. Even pros rarely nail the bottoms and tops. Dalio's point, don't try to be the crystal ball wizard of Wall Street. Instead, focus on having a portfolio that can weather any storm. The 15 good uncorrelated return streams mantra. Dalio suggests spreading your money across about 15 different investments, what he calls streams, that don't move in lockstep with each other. Uncorrelated means when one investment dips, another one might stay steady or even go up. Think of it like a diversified buffet. If your chicken dish is under-seasoned, maybe the pasta is amazing. You don't want all 15 dishes tasting the same, or you'd be just stuck with a 15-dish disaster when that flavor goes south. By owning a mix of things, stocks from different industries and regions, bonds, commodities, maybe real estate, currencies, etc., you're not overly exposed to any single market event. Risk balanced, the secret sauce. It's not enough just to own lots of different assets. You also have to balance them so that each contributes fairly to the overall risk of the portfolio. Imagine 15 boats tied together on a lake. If one boat suddenly takes on water, i.e., crashes in value, risk balancing makes sure the others won't all sink with it. Dalio's approach, often called risk parity, means adjusting the sizes of those positions so that no single stream ever becomes the dominant driver of your portfolio's ups and downs. You might have more the holy grail of investing. Why the holy grail? Because in his experience, this setup gives you roughly the same average return as if you just put all your money into the best performing single asset in your mix, but with about 80% less risk. Imagine if you could earn the. What is correlation? Think of correlation like the dance between two investments. When two dancers move exactly together, same steps, same beat, that's a plus one, a perfect positive correlation. If one leads and the other follows exactly, they're inseparable. Plus one, perfect positive. If stock A goes up 5%, stock B goes up 5%. If A falls, B falls by exactly the same. Zero, no correlation. They're at separate parties, no connection at all. Stock A could be skyrocketing while stock B drifts sideways or even down, and there's no predictable link. One, perfect negative. When one jumps, the other sinks. Imagine a seesaw. As one side goes up, the other goes down. Real assets rarely sit at those extremes, but correlation gives us a handy snapshot. Are they moving together against each other or independently? Why we diversify and why it can backfire. Diversification is the idea of not putting all your eggs in one basket. You buy a mix of stocks, bonds, maybe real estate or commodities. The hope is that some of those eggs will hatch even if others break. But here's the catch. Diversification only works if your baskets really behave differently. If all your baskets end up falling off the same cliff, you're right back to square one. In calm markets, tech stocks might zig while energy stocks zag. Bonds might chug along steadily. In a crash, though, investors panic across the board. They sell whatever they can, wherever they can. Suddenly, those baskets all head for the same exit at once. During the 2008 meltdown, you could be spread across banks in London, tech companies in Silicon Valley, and municipal bonds in the Midwest. And they all went down in unison. That's why folks in finance grimly joked, "In a crash, all correlations go to one." It's dark humor, sure, but there's truth to it. Fear can override the usual differences between assets. Ray Dalio's twist: seek truly uncorrelated holdings. Ray Dalio, the guy behind Bridgewater Associates, says, "Okay, if most things start moving together when the tide goes out, we need some boats that float on different waters." His all-weather approach means find assets that don't just look different on paper, but actually respond differently when the economic weather changes. Mix them so that when one is getting drenched, another is basking in sunshine. Examples of uncorrelated behavior. Inflation rising, stocks often struggle because higher input costs and squeezed consumer budgets cut into profits. Commodities like gold, oil, or corn tend to do well. When prices are going up across the board, these raw materials actually become more valuable. Interest rates climbing. Banks can profit. They charge more to lend money. Real estate usually cools off. Higher mortgage rates discourage homebuyers. By blending these, you're not just holding a bunch of stocks and bonds. You've got a little inflation hedge, a rate sensitivity hedge, and more. To put his ideas into practice, Bridgewater teamed up with the folks behind the SPDR funds. In March 2025, they launched the SPDR Bridgewater All-Weather ETF ticker ALLW. This fund is structured to spread investments across stocks, bonds, commodities, and inflation-linked assets. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and hit the bell so you don't miss the next one.